Hi everyone, Lee Pakia here, and I'm joined now by Professor Houman Shadab. He is a professor of law at New York Law School, and we're going to be talking about tech startups today. Thanks for stopping by.
Thanks for having me.
You said in a recent blog post that it's actually getting easier these days to start a startup company and be an entrepreneur, not just for technological reasons or developments in technology, but also because of changes in the way these entities get financed. What specifically did you mean by that?
Sure. So in many ways, as time goes by, it's been easier to start a company, and part of that is because it's easier to find investors or find financing for a company. So as far as starting a company goes, it's easier to find maybe information about how to start a company, attorneys online, documents to get started, the cost of software, the cost of infrastructure have plummeted. But part of the financing side of the story is that, first of all, there's just more financing. There's a glut sort of capital available that's looking for returns that are maybe different or above the stock market, and certainly returns that are higher than anything that fixed income or bonds can provide, with interest rates being so low. So one way investors can get into that higher yields, probably higher risk, is to sort of directly or indirectly go into the startup or venture capital space. So generally there's lots of capital out there looking for sort of above average returns. And second of all, there's lots of different types of financing now available for startups that there really wasn't at all, or as much as, let's say, a decade or a decade and a half ago. So we have, of course, traditional venture capital, which itself is changing. We have, in the past, let's say, half decade to a decade, the rise of angel investors. And now we have crowdfunding. Crowdfunding in the sense of getting a bunch of investors together, pulling capital from smaller investors and giving it to smaller companies. So we have maybe crowdfunding that goes towards nonprofit projects. We certainly have crowdfunding that gives a reward system like Indiegogo and Kickstarter. We have, on the profit side, we have crowd lending, which is becoming a very big space, also for institutional investors looking for that little bit extra yield. And we have types of equity crowdfunding, which will probably be developing when the regulatory changes happen in months to years from now.
All right, I want to get to those changes in a moment, but we were talking in the green room before about how we're, just generally speaking, seeing larger investments and more control and power given to the investors rather than the entrepreneurs right from the outset of the engagement. Can you talk a little bit about why that's happening and how it's changing the way startup ventures are being run and operated?
Sure. So one of the macro changes going on here is really the professionalization or institutionalization of starting a business, being an entrepreneur, and on the investment side as well. So whereas before maybe entrepreneurs would rely on friends and family, credit cards or other sources of capital, which is sort of less formal, but would come in the form of sort of common stock. These days, you've seen the growth of angel investors and the growth of sort of micro VCs, micro venture capitalists that are willing to make investments in smaller companies. And so startups, they can get much larger sources of sort of seed capital at the early stage, but in return for that, the investors are going to be more sophisticated than your family,
for sure.
And they're going to negotiate more rights for themselves, not as much as the full-blown venture capital investments, but they're going to get something in between common stock and a pure sort of convertible preferred share that venture capitalists typically have. So they'll do something in the form of series notes or series shares that do allow them to convert, for example, to their common stock if the company does well at a fair discount, like 20%.
Is this a good trend in your view?
I do think it's a good trend because I do think that these sort of micro VCs or larger sources of capital that are available for companies at the earlier stage of the growth are good because I think generally professionalization is sort of helping entrepreneurs build their companies, build their networks, build their contacts in the way they need to, and not make the earlier mistakes. On the flip side, being able to postpone, in many cases, valuation to a later stage of growth of the company is really important for entrepreneurs. And just maybe the more obvious point is more money is generally better than less money. And so if you can just sort of get a bigger pot of money at the outset, and that allows the company to test their idea, test their product or service, and experiment, that is a good thing. And generally what we're seeing maybe more broadly is it's never been easier to sort of experiment with an idea than it is now through either these informal crowdfunding, perhaps, let's say networks, or these more formal yet small investments coming from these micro VCs.
For people that pay close attention to this space, what regulatory changes are coming down the pike that they need to be aware of?
Yeah, I mean, there's not a ton in the sense that, let's say, hedge funds and private equity funds, after the Dodd-Frank Act, they were explicitly regulated as investment advisors. Venture capital investment advisors were basically exempted from that regime. Nonetheless, though, there is a sort of more subtle issue relating to how the SEC defines accredited investors. So generally speaking, to make an investment in a private company that's not on a stock exchange or something, or not on the pink sheets, you need to be an accredited investor, which basically comes down to wealth tests for natural persons, non-institutions. That means either as an individual you make $200,000 a year, or you're worth more than $1 million a year. Well, the SEC, there's sort of both sides of this. So the SEC has said the general idea behind that is it protects investors from basically losing all their money. But the SEC is saying, well, maybe those wealth tests are not in congruence with investor sophistication. Certainly, regulators recognize, sort of obviously, that you can be a sophisticated, non-wealthy investor. Probably the flip side as well. You can be quite wealthy and be unsophisticated. Yeah. On the other hand, probably the financial crisis showed us. But the question is, where do we go with this? Do we actually increase the accredited investor limitations to index to inflation, which would actually probably wipe away about 50% of the ability of the Americans to say able to invest in small companies? Or do we look at other ways to allow investors that are not rich to invest in small companies? The SEC is thinking about that right now. The impact now on the startups or venture capital space is that many angel investors, maybe up to 30% by some estimates, if they did, let's say, raise the definition of accredited investor to adjust for inflation, would not be able to invest in companies. In other words, angels would not be able to be angels anymore, because angels, almost by definition, are not as large or as rich or institutionalized as venture capital investors, as institutions, yet they do play a really important role in helping startups get that initial capital they need and develop those sort of business skills going forward.
There is so much media attention going into the startup space these days. Are you concerned that we're starting to see a bubble emerge?
Well, certainly when there's new network television shows about startups, there's always something to think about there. But I think a part of a great and unique part of culture of America is that we have something really focused on entrepreneurship. And you do see that actually spreading throughout the world. In general, the startup scene is bigger all over America and quite frankly across the globe also as well. So part of the maybe problem with that, though, is that, well, is there too much focus on this? Is it too cool and too hip? And even that, maybe that sort of sentiment bleeds to the professional investor side, to valuations. And I am a little concerned about maybe tech valuations being a little too high. I think especially during the later stage Series D, let's say, investments, that's where the valuation growth has been the highest. And part of the reason of that, too, is because you're seeing actual non-venture capitalists enter that stage, like mutual funds and like hedge funds, who have not been traditional investors, but again, looking for that extra return, basically right before a company goes public. And the reason for that is once these companies have gone through so many stages of investment, have matured, have grown, and they're basically about to go public, they tend to be in pretty good shape. And that's why I'm not overly concerned, though, about a tech bubble, because tech companies, for example, by going public now, are much healthier by various metrics, at least, revenues and profits, than they were, let's say, during the classic dot-com bubble.
Good stuff. Professor, thanks so much for stopping by.
Sure.
That's Professor Houman Shadab from New York Law School. If you'd like to see more of the stuff that they're working on, be sure to go check them out on YouTube, and you can always follow them on Twitter. I'm Lee Pacquiao. Thanks for watching.